almost 40%. This means that additional inflationary pressures will have additional inflationary pressures to the country, which cannot be absorbed because inflation is already too high. This is not the case of Peru and Colombia and Chile. So those countries, the Andean countries, may be less impacted by this process of currency adjustment than countries such as Brazil, Argentina, and Uruguay, for instance, due to inflation. And another way of saying the same thing is that while in countries such as Chile and actually Mexico, Peru, Colombia, interest rates may remain basically stable, in Brazil, where we face a high level of inflation and a high pass-through of depreciation to inflation, we are going to see a tightening process of monetary policy. Interest rates will have to be increased, and as a consequence, growth will be particularly more influenced by monetary policy than in those other economies. So as we can see, we expect, apart from the issue related to inflation, countries with higher levels of investment to GDP also will be benefited by faster growth. One way of compensating for this productivity issue, mentioned already by Bill, is through investment. Some countries, such as Peru, for instance, invests 27% of GDP. So it may be able to grow, to have a potential growth much higher than in Brazil. Brazil, with 18% of investment of GDP, probably has a potential to grow something like 3% per year, or 2.7 as mentioned by Bill. But we estimate that if it goes from 20 to, let's say, 25% of GDP, another percentage point for potential growth could be added to the economy. The challenge is doing this, of course. So, as I told you, the impact on economic growth has already been more intense on countries with higher level of inflation, such as Brazil, Argentina, and Uruguay, what we call South Atlantic countries. We call the Pacific. Chile, Peru, Colombia have been also slowing down its pace of economic growth, but not as much as in Brazil. We forecast, our short-term forecast for those economies are here. We believe Brazil will grow something like 1.7%. Mexico is still struggling, also between 1.5, 3.8, recovering faster than the other economies, as I already told you. But in general, we are going to see a 2013 expansion slower than in 2012. Some, just very briefly, addressing some issues regarding challenges and opportunities. Infrastructure is clearly a challenge for Latin America in general. Latin America is not as I have the red bars refers to Latin America countries, and the gray bars refers to other BRIC economies. Latin America is not particularly very bad, but of course we have some countries such as Colombia and Peru, not very good position in terms of infrastructure. Another challenge, of course, is related to taxation. Brazil, it's an example of a high bureaucracy country, 2,600 hours to pay taxes when compared to other economies, which 400, 300 hours in terms of effort to fulfill, to do the bureaucracy related to the payment of taxes. Violence has been a problem. Productivity, as already mentioned by Bill. And I would like to focus a little bit also on the opportunities. We think we are going through this adjustment process, which should slow down economic growth, as already mentioned. It's in the next 1 or 2 years. But in the end of the day, we still see some important favorable factors for Latin America. Look at the dependency ratio, the demographic bonus. Demography in Latin America is still very favorable. Very differently from China, from the US. China is not that bad, but they have reached the bottom of the dependency ratio. The dependency ratio is the ratio between non-working age population to working age population. So the more working age population you have relative to non-working age population, 0 to 15 years or plus 64 and above, the better, because there are more people working to sustain or to pay for education for the younger and the retirement of the older. So in terms of demographic bonus, China has reached its bottom on 2010, and Latin America is expected to reach the best part of the bonus in 2015. So it's an advantage. Population, total population, working age population will keep increasing faster than other non-working age population. Also, inequality is at the same time a challenge and at the same time an opportunity. Latin America have been reducing poverty, reducing poverty in percentage and in million of people, and increasing middle class. Middle class have been increasing in Latin America in general. It's not only an event, it's not only a phenomena happening in Brazil, it's going in other countries as well. Another opportunity we see for Latin America is the fact that credit penetration has still room to increase. Some countries such as the US, Spain, or even China have reached very high levels of credit to GDP, while in Brazil, Colombia, and not Russia, but Brazil, Colombia, Chile, we are in the early stages of the credit penetration and the credit cycle, and some countries have not even started the credit cycle. So there is, and this phenomenon is associated to the construction sector, particularly the housing segment. As credit penetration starts to increase, the housing segment develops, and this is an important opportunity in terms of growth and demand for your products as well. In terms of credit growth, we have been seeing, although the world have been slowing down, some countries deleveraging, credit is growing almost 10% in real terms in Chile, 8% in real terms in Brazil, and 5%, 6% in Colombia in real terms, which are very decent paces of increase. So, just wrapping up, we are probably going to see a currency adjustment. We need to address the issue of productivity. Income distribution is a challenge and an opportunity as well. It's a fact that Latin America have consolidated a democracy in most important countries, at least. It has an important amount of the world's oil reserves and natural resources, and countries pursuing market-friendly policies, as already mentioned by Bill. So we think that we are going to have room to increase the pace of economic growth after 1 or 2 years of currency adjustment, as pragmatic policies and market reforms are implemented. Some of the reforms mentioned by Bill as well, so we actually believe prospects for Latin America are very positive. We have to undergo this period of currency adjustment, but then we'll probably be able to resume growing back around 3.5 to 4% again until the end of the decade. So that's it, and thank you very much once again for you to invite me.
Thank you very much. Thank you very much, both Bill and Maurizio. Lots of food for thought in your presentations. We're going to throw this open to the audience for Q&A, and I think David's going to moderate it. So David, if you'd like to come up on the stage, and there's some microphones sitting on the chair there.
Let me kick it off asking a couple of questions to you, Bill. First one is, you mentioned informality. I was wondering if you could elaborate on what exactly that is and why it's such a drag on productivity improvement. Then my second question, if you like, the $64 billion question. What is required to improve the prospects for Brazil beyond 3% that you had in your chart at the end?
Well, informality is perhaps the item in the microeconomic agenda that at McKinsey we have found consistently in our research on global economic performance to be a severe and fundamental cause of differences in productivity across countries, and it's not always recognized as so. And what informality does is it creates an uneven playing field. So it allows low productivity companies to remain low productivity and still be competitive within the different markets. So, for example, and this is particularly profound in the very large employment sectors of an economy, which ultimately constitute that long tail that we were talking about. So imagine construction or imagine food retail. These are huge sectors, account for big chunks of employment, big chunks of GDP, but where informal operations can be very competitive, if not productive. This is particularly acute in Brazil because the burden of formality, of complying with labor laws, tax laws, all the other types of laws, is so profound. This gives a huge advantage to the non-competitive companies that keeps them informal, keeps them small, forces them to remain small, and at the same time makes it very difficult for the bigger companies, that small tail with the high productivity, to gain share. This pattern we find in countries like Brazil, like Turkey, like Portugal, all the mid-income countries like India, and it is, in our opinion, the most important factor above and beyond infrastructure, macroeconomic stability, all the usual items of the agenda in terms of being the core cause of severe productivity differentials across countries. Having said that, one thing then is shifting the level of productivity overall, which requires, I think, a major effort on informality. But then, what would require, in my opinion, a change on growth prospects for the region, and particularly thinking the big economies, and particularly thinking Brazil, frankly, which is about half of the region, would be a change in sentiment regarding the quality of policy. I have a personal conviction, nothing could prove it, that if there were a sense that there were a commitment to sound macro and micro policy, that change in sentiment in and of itself, and if corroborated by effective action, would bring that extra 1 to 1.5% of GDP. There's a sense that once again, yet again, some of these countries are shooting themselves in the foot by poor set of, choices on the micro and macro policy front.
Yeah, so then just one quick follow-up question. Given there's an election next year, what's your probability of those sound policies in the near term?
It's very difficult to say. I'll answer your question. I'll do the typical thing. I won't answer your question. I'll evade it if you don't mind. But what I have answered similar questions before was the following. The way, at least again, thinking Brazil with the election, since you refer to it, that I have thought of is that the biggest risk to Brazil is the self-inflicted risk. At least our perspective is that quite severe things could happen outside of Brazil, and the Brazilian economy, for its peculiarities, would remain resilient even to very, very severe events abroad. A severe slowdown in China, not your sector, but the economy as a whole would remain resilient. So the risk is really self-inflicted. And I have always thought, and I continue to believe, that this is the quote-unquote the best moment in the cycle for investment in Brazil, because the policies may not be as market-friendly as they would like, but they're at least responsible, that they're in the realm of the responsible. And the possibility that this not continue within the next 1 or 2 election cycles is small. So a chance of material improvement in the micro and macroeconomic agenda, difficult to foresee. A chance of material deterioration is more difficult to see. And if you're betting on the potential upside, it might not be a bad moment.
Okay, couple of questions for you, Maurizio. First of all, you mentioned your view that the real will be. How can that be fixed? policy is my first question. Second question, when you mentioned about increased credit, my understanding is consumer credit in Brazil or household debt levels are very high. So I presume you're talking about credit to businesses, and how do you see the credit issue for households and what's effectively been a bit of a credit fueling growth in the consumer sector, how that's going to play out?
Okay, thank you. Thank you. As for the currency, the challenge is, I think that one of the most important mistakes the government have made in terms of macroeconomic policy recently have been to accept inflation running around 6% for a long time. So now there is not much room for the government to accommodate higher inflation as a consequence of depreciation. So that's why monetary policy will have to be tightened, and economic growth and domestic demand will have to slow in order for the currency adjustment to happen and inflation not to increase. And in other words, in order for a nominal depreciation of the currency be translated into a real depreciation of the currency. So I think the only way out of this situation now is let the currency float as it has been floating recently. This is an important advantage of the country, the floating exchange rate regime, an important strength, an important fundamental. And the central bank has to do whatever is necessary to at least prevent inflation from going up, and in the best case scenario to bring it down towards the target, which is 4.5%. In terms of credit, I totally agree. Brazil have been the level of credit is around 55% of GDP, but housing, credit related to housing is only 7% of GDP. So there is a huge room to increase this type of credit. For consumers, most of the credit is related to consumption. So interest rates are very high and tenors are very short. Maturities are very short. So the debt burden for the consumers are very high on this kind of loans. So the challenge here is to shift from consumer loans to mortgages, which is already happening. Mortgage credit grows around 30% per year, while consumer credit grows below 15% per year. It's already going on, but it's a necessary step for the country to advance and for it to have a sustainable credit cycle. In terms of companies, I think what's necessary and what's going to happen is a revolution on capital markets. Still in Brazil, we have a problem. One of the most important difficulties we have is that, according to our estimates, something like 40% of the financing for companies is either BNDES or their own resources. Capital markets may be responsible for something like only 10% of financing for the companies. It's very low. So there's a need to migrate from a model of government financing of companies using their own resources towards a more market-oriented type of financing. So that's the idea.
Okay, I'll open the question up now to the floor. Lou?
I have the impression that the fundamentals are more positive. Now, maybe it's just anecdotal that we see a lot of our customers who are manufacturing companies, auto companies, for example, building capacity there, and you're talking about the broader economy. We certainly see the violence challenge very directly in our facilities, but beyond that, I'm a little bit surprised that you have a very similar view on Mexican prospects as on Brazilian prospects, where from the outside I look and see the credit bubble, for example, the potential credit bubble, more risks in the Brazilian economy than I see in Mexico. So I just wondered if you could amplify either one or both, just confirming that similar view of Mexico and whether you'd see the risk profile being a little bit different between the two major economies.
Well, from a financial market point of view, I have been talking to a lot of investors. We go to a lot of countries trying to express our views on the economies as a service. And what we have been feeling on the side of investors is that they are much more optimistic regarding Mexico than Brazil, particularly because there is an agenda of reforms in Mexico going on, Government want to change things, want to change labor, want to change energy, want to change, want to implement a tax reform. So markets are kind of more benign regarding Mexico than Brazil. And Brazil, on the other side, have been disappointing, both in terms of growth and in terms of policies which have been adopted. So at this moment, the assessment of Mexico is seen by our clients, our investors, as much more favorable than in Brazil. I believe this is something related also to the political cycle. I would wait a little bit to see the next government. We are in the end of a political cycle, in the last year of a mandate. Let's see what's going to happen in 2015. I believe that in 2015 in Brazil, we will also have promises of reform, a new government with another political capital, and promising reforms, trying to implement an agenda. So I think the situation may change from now to 2015.
I think I'll add 2 points. The first point is that the reality of Mexican performance over a very long time, particularly productivity, has not been what it could have been. It has not realized the promise. So that's, a fact is that there has to be a shift in reality for this optimism to materialize. A second aspect is just perspectives that come from our McKinsey office and people that have worked in Brazil and Mexico at McKinsey, and their sense is that whereas the current sentiment is excessively pro-Mexico, anti-Brazil, let's say, currently, as it was excessively pro-Mexico, pro-Brazil, anti-Mexico a few years ago. So maybe there's a tempering of this optimism that you're perceiving and you're perceiving when you just take a more fundamental perspective of the realities of the two countries.
More questions? Raquel.
Raquel from Flat Carbon South America. In the short term, if we have to face a worst case scenario from North America Congress, what we can expect as consequence for Latin America and this currency adjustments?
Well, this is also a tough question, and you were referring to the debt ceiling, to the decision of the debt ceiling. We see two critical dates here. November the 1st, there is an important payment for Social Security in the U.S. They may not be able to have money to pay for Social Security, for pensions, and for retired people. And on November 15, there is an important payment of interest from U.S. Treasury. So those 2 dates are critical in terms of the debt ceiling. If the debt ceiling is not addressed and the government is not able to issue new bonds, they are going to default on those payments. If they default on those payments, as we have been seeing, as paradoxal as it appears, this would probably lead to more volatility to markets. This is not paradoxical, but in the case of the currency, we would probably see a weaker emerging market currencies, much weaker and much more volatile than before. This does not particularly against other currencies such as the euro, such as the yen, such as the pound, maybe not as much as compared to the US currency, but volatility and increased risk aversion will be a characteristic of this scenario you have been suggesting, and this is usually not favorable for emerging markets in a whole.
Based in your presentation, it seems that Pacific countries has a better level of control in inflation and also a better level of investment. And now they have established an agreement of free trade between them, including Mexico. So my question is, what are the consequences of this agreement for Brazil economy in the medium and long term?
I think there is no direct consequence for Brazil, but it's just there is an informational consequence here. It shows that Brazil is kind of losing territory by trying to focus on not focus on this kind of agreements, the kinds of bilateral agreements or multilateral agreements, refraining from integrating to global markets. Brazil is still a very closed economy. One of the most important characteristics of Brazilian currency is its volatility. The volatility of Brazilian currency is higher than other economies, and this is basically due to the fact that Brazil is a closed economy, only imports 10% of GDP and exports 10% of GDP. So it just showed that the country is losing ground and is losing market share in the world, but there is not an adverse direct consequence from this agreement. But it would be, we would appreciate if Brazil could engage in such agreements and open up the economy, reduce tariffs, and probably this would increase also productivity, competition, and so on.
Bill, you have anything to add?